Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and we are live. We are here talking about index universal life versus whole life insurance. I wasn't actually going to go live today. I decided to do this kind of last minute. I had a conversation with some people, actually with a couple individuals, talking about IUL, talking about how it's sold, talking about like their misunderstanding of it and kind of what their journey has been, in the process of really beginning to understand what index universal life insurance is and kind of how it's different than what they're being told. And my belief is, and my passionate belief is the fact that index universal life insurance is one of the most misrepresented, if not the most misrepresented financial product in financial history. And I know that's a bold statement, but the problem is, it's a top-down issue. And what I'm going to cover in this, as I go through this video, what I'm hoping to do is break down the simplistic kind of element of what is index universal life, what is whole life insurance. Let's compare them against each other in all these different areas and really figure out what is the right fit. And I get asked a lot, and I don't know why, but I've been getting asked a lot more frequently, when is index universal life a good fit? Who is it the right fit for? And my answer is always, it's never a good fit. It's never going to beat whole life insurance when you really look at actual performance. I will say this, on an illustration, index universal life is going to beat whole life insurance almost all the time. But life doesn't exist on an illustration or a spreadsheet. Life exists in life, and how the policies actually perform matters, and that's why I created the IUL challenge, is to show that IULs don't perform the way that they're sold. And they're sold on upside potential, downside protection. And the IUL challenge is basically saying, all right, this product is sold as a product that captures upside potential due to participation in the markets. Well, why during the greatest bull run of all time have they not outperformed their illustrations that they were sold on, right? I think that's a really important thing to understand. And so we're going to get into that. We're going to talk about all this stuff. And so my ask of you guys is that you ask questions. If you have, as we go through here, engage, ask questions, comments. I'm going to do my best to keep this as dialed in and focused as possible. I fully expect we'll go on some tangents as people ask questions and we get into it. And so we'll go from there. So Benjamin asked a question. Speaking of questions, Benjamin asked, can I get out of debt while funding my policy? I assume he says finding, but I assume he meant funding. Autocorrect on spelling. Or should I focus on one thing at a time? So, all right, this is not the topic of today's video, but I will answer this really quickly since you asked the question. I would never use IUL for any kind of debt situation. That's important. Secondly, the debt conversation around utilizing whole life insurance to pay off debt always varies circumstance by circumstance. It's going to be really dependent on you. It's going to be dependent on the type of debt that you have, the structure of that debt, the interest rates. It's going to depend on what's your financial situation look like right now as far as cash flow, excess cash flow that you have available every single month. It's going to have, do you have a pile of money sitting somewhere that you could, basically front load into a policy and like refinance your debt through the policy? There's all these different variables. So if you are interested in like talking through all those variables and like what it could be like for you personally, I would go down below. There's actually a debt elimination consultation that we have, because this is such a personalized thing. And I do like the idea of utilizing a policy to help eliminate debt when it is right for somebody. But the challenge is the variables of when it's right, when it's not right are so wide that it really is a personal thing. So you got to be willing to sit down, talk with somebody, and guide people through, or be guided through a process to see what makes the most sense for you. And so I would say go down below in the description below and check that out if you are interested in having a debt consultation. I think it's something that is worth a conversation. And we have a guy on our team, Julian, who is, that's like his specialty. He's amazing at guiding you through that process. And we have all sorts of software that can help give you clarity around that. So meet with him on that if you're interested. What do you think of Northwestern Mutual's whole life policy? I'll say this, Northwestern Mutual, it's not that I don't like their policy. I don't really like the Northwestern Mutual culture, if I'm going to be really real. They kind of have this like chest thumping, like we're the best of the best. We have the best general fund and we have the biggest general fund and we're the most solid financial company in the world and no other company can compare to us. And, you know, to me, that's a bunch of BS. They're a good company, but there are a lot of other good companies too. And when you're talking about whole life insurance companies and the way they operate, they're all like, when you talk about the top 5 to 10 companies, it's also similar that nobody really has a significant advantage. That's kind of the way I look at it. So that's that. The things about Northwestern Mutual that I don't like, I guess I'll start there, is their direct recognition, which I'm not a huge fan of. Like it's not a bad thing, but just personally, I prefer, and I did a video on this the other day, I covered this topic, but I prefer non-direct recognition if possible. My challenge with Northwestern Mutual is that they don't really allow you to design policies for the maximum cash value accumulation. They just don't allow for it. They don't allow you to put enough paid up additions in. They don't allow you to jam enough money in, front loading them. They don't offer enough flexibility in those terms. And so from that perspective, if you're looking at it from a banking perspective, you know, then I would say there are other companies that are better. It doesn't make Northwestern Mutual bad. It just means they're not the best. It just means there are other companies that are going to be better business partners with you if you're looking to become your own banker, right? Like you got to look at it as a business, and as a business, the carrier, the company that you're buying a policy with is your business partner, and Northwestern Mutual would not be the best business partner for that. All right, so I love all the questions, guys. So I'm just gonna keep answering questions, and then we'll get into all the other stuff. And if you're watching the replay, I'll timestamp all this. So if you don't want these questions and you want to jump right into the topic, you could do that. But thank you in advance. The focus is cash value, whole life, 90-10 for investment, taking the loan against the policy and not worried about the death benefit. How much should you put cash upfront instead of unfront, maybe, I think is what you meant. Also, is there a fee to consult with your firm? No, we don't charge a fee. There's no fees. You could go down in the description below, set up a clarity call. Our goal is to literally just answer questions and give clarity. I always tell people I'm a hardcore education guy. I never believe anybody should put money into anything they don't understand. I believe in what we do. I believe in our ability as an agency and as an organization to educate people. I think nobody can come close to the level of service and education we put into our clients, and that's why we do what we do. I just think money follows value, right? Like, so we don't charge for our advice. We don't charge for our service. We don't do any of that. We believe I want to give you all the best information as possible because I love this industry. And if you're going to do this, I want to make sure you do it the right way. So whether you work with us or not, we're happy to give you all the information that you need. And we just believe that if you have a conversation with us and we have a real full conversation, you're not going to want to work with anybody else because you're going to realize like what we put into everybody that we work with. And I think that's an important thing. So down in the description below, there's a clarity call link. You could set up a call. But now to answer your question more directly, if the focus is the cash value 1090 policy for investment, taking a loan, and you're not worried about the death benefit. So here's what I would say. I'm gonna answer this question by going to my whiteboard. I did this the other day a little bit, but I'm gonna do it again just because we're here. So I always say 1090, not 90-10, just so you know, because I always do the base first and then the PUAs, because the base is the foundation of the policy. So I always say the foundation first. So 10%, 90% is what we're talking about here, right? So there's a couple things that you have to think about. You have to think about the terms of like when you build a policy, what is that policy made out of? The policy is made of the base coverage. I'll just write base cov. It's made of paid up additions, and it's made of a term rider always. And it could be, and that term rider can be different types of terms. It could be a blend. It could be a level term. There's all different companies do it different ways. Different companies offer different options. And so that's, these are the three things that matter, right? So it's important to understand your goals and objectives. If your goal is all cash value and immediate liquidity of as much money as possible, then yeah, this is fine. But it's important to understand your age and your time horizon on how you want to fund this policy is also extremely important, because the longer you go on, obviously the goal is to get as many PUAs as possible, but we also want to avoid MEC, right? We don't want to MEC this policy. So in order to avoid MEC, that's where the term rider comes in. And the term rider, for the length of term that goes on the policy, it can get expensive. I like doing level term insurance because it reduces those costs. There are certain companies that will do annual renewable term in the policy, which is kind of like a feature that IUL has, is the annual renewable term. And that makes it so the drag, because this term insurance rider is a drag. So let me explain it this way. I'll throw some numbers at this just so it makes sense. Let's just say we have a $10,000 total premium, okay? Out of this, if we're talking about 1090 policy, right? We got $1,000 is the base, and then we have PUAs, and we have term, right? That's how it has to be. Now, a lot of times, people are going to say, "All right, we want to put 90% into PUAs, but it's really not going to be 90% because we have to think about what's the term coverage that we're going to need to add to the life insurance so we can get the PUAs in." So in this situation, it might be that goes $8,000 or maybe $8,500 or whatever, but for the sake of it, we're just going to say that, and $1,000 for term. So it really, even though we're looking at this blend of a 90-10 or a 10-90, you really only have about 80% going into PUAs. And then you have to think about what is the load charge of those PUAs from a liquidity perspective, right? And there's some companies, they're anywhere between 5 and 11% is typically the load charge of those PUAs. The base is always going to be the most efficient, and the base is always going to have the best dividend, right? And so what I believe, what I think is really important for people to understand when we talk about this, and one of the reasons I'm not a big fan of 1090 policies, not that I hate them, not that I don't think they have their place, because I absolutely do, but I think people that say that from a blanket perspective that 1090 policies are the only way to go, I think they're missing the boat, and they're not really planning from a long-term perspective. And when we think long-term, what do we think about? We want to think about cash value access, which obviously on the short term, that is what it is. But we also want to think about cash growth. So when I say cash value, I mean like short-term cash value, like immediate access, first 2-3 years, or maybe first 1 to 5 years. And that is what it is. But we always want to focus on cash growth. And when I'm thinking cash growth, I'm thinking 20, 30 years out, like depending on your time horizon. There's no free lunches in this life insurance game. And at the end of the day, if you want that short-term liquidity with the 10% base and a 90% PUAs, you're going to get there and you can have that. But the problem is it's going to come at a cost of your long-term cash flow growth or your cash growth. So you got to find a good blend that kind of meets all the objectives. Now, the other thing is, I would say living benefits. You may not want it for the life insurance, but you probably would want it for the living benefits. And that's where I'm saying work with a company that has the best living benefits to make sure you can accelerate the death benefit to pay for medical bills, to help you out in that way. And it's going to be really good. Now, in the interest of this conversation for the video about whole life insurance versus index universal life insurance, I would say that both insurances have living benefits, and a lot of IUL agents will kind of position it about IULs having living benefits, and they say whole life doesn't. I cannot tell you how many times I've heard that. Makes my head want to explode because nothing could be further from the truth. But that is what it is. So does that make sense as far as 1090 policy? I would say and what I would also say is this, because I guess now I'm reading the question again, is what should you put, how much should you put up front? Well, I would say I don't ever worry about how much I want to put up front. I'm always thinking about it in the terms of cash flow. So what I would say is figure out what you can afford and what's comfortable from an annual perspective for a premium. And then we think about annual premium first, and then we figure out max front load based on premium. If you work it backwards, you can kind of put yourself in a bit of a bind. If you say, hey, I want to front load $250,000 or $1 million or whatever it is, and then you try to reverse engineer that, it may stretch you a little bit too much as far as how much you can actually afford per month or per year. And so I always say, let's figure out the annual or monthly premium. What's that number for you? And then from there, we could figure out the max front load that we could get into it. So for instance, I could say, all right, you could afford, let's just use this $10,000 example. Like, if I know that that's what you're going for, I'm going to tell you that we could probably put in $100,000 to $120,000 would be the front load that we could jam into this thing. But it doesn't start with this; it starts with this, right? Like, that's the important thing. It's you got to do things in the right order, and it's all got to be process driven, and it's all got to be designed to meet your goals and objectives, right? Like that's really what it comes down to. And as much as I love this, and as much as I am a huge advocate and believer in whole life insurance and as a banking alternative and all these different things that we talk about on the channel all the time, I also am a believer that you got to be careful and manage cash flow, because your financial success is going to be based on your ability to manage your cash flow effectively and use that cash flow to create opportunity and put yourself in a position where you're not at unnecessary risk. So yeah, SB, feel free, reach out anytime. Happy to connect. Got an amazing crew that can help you out, and that's what it's all about. So anyway, guys, can everybody give me if you're here? I got 22 people live right now, so I'm kind of curious to see if you're here and if you're like an IUL person, because the topic of this video is whole life versus IUL. And one of my big passions in life, because of my background as somebody who used to sell a lot of IUL and used to be the director of business development for one of the top IUL companies in the country. And now I'm obviously a raving fan of whole life insurance. And because of the fact that IUL has kind of grown into this monster in the industry of this, what I would consider the most misrepresented product in the business, because of all the IMOs like WFG and PHP and PFA and like all these other companies, I think it's a top-down problem, and the companies, the corporations, the carriers are giving half the information to the sales force and to these IMOs. And so get a lot of people out there that are misrepresenting what the product is, not because they're bad people, not because they're malicious, not because they have bad intent. I think most of these people want to help, the people they're trying to serve, and they get into this business and they get excited about selling an IUL as a product, as a solution to a problem, because they believe what they're told, but they're only being told half the truth. And so a lot of the content that I make is not designed to bash IUL, it's designed to educate people so they can start asking more critical questions, and so they can have a better understanding about how things actually work. That's really what inspires me, I guess. I know for every IUL agent that I can get to see the light, I probably save hundreds of people, right? Like that's really my driving force in this space. And that's honestly one of the reasons that, we bring on so many agents and we help them now. And, our IMO now we're growing. It's been amazing. But I'm a big believer that if you're an agent and you're watching this, you need to be dedicated to challenging yourself. One of the biggest problems that we have in this business is confirmation bias, and people just focusing on their perspective and kind of sticking their head in the sand and not wanting to uncover information that would potentially put them at risk of being wrong. And so I would argue we have a responsibility to do right by our clients and be able to serve people and challenge what we think to be true constantly, because the environment is always changing, the economics are always changing, and we have to make sure we're doing this in the right way, right? Like, and that we're building ourselves as an asset that we can add more value to the people we're trying to serve. Like that's my overriding kind of belief set around all this and kind of how I think we need to function in this business. And I think we need to set up systems and organizations that actually are trained and designed to train agents to bring more value to people rather than just sell a product. And I think it all comes down to understanding what the product is, right? And that's kind of what inspires me to do what I do and create this content and build the organization that we're building. So that said, I'd be curious. Give me a 1 if you are an IUL, an agent that focuses on IUL. Give me a 2 if you're an agent that focuses on whole life insurance, and give me a 3 if you are like somebody who's interested in implementing this in your life, or you are just kind of somebody who uses this strategy in your life. Maurice, what's up, man? My wife and I left term and invested difference company and moved along to an IMO, an agency who likes to sell Mutual of Omaha IUL and the National Life Group IUL. What can you recommend for us to get up to speed on the whole life versus IULs? Well, so I would say I've got a training playlist on Index Universal Life that you should probably watch. I think by the time we get done with this video, if you hold tight and ask questions, I'm gonna get into this a little bit. I'm gonna start with the foundation of IUL. In the next hour, and maybe I go for 2 hours. Honestly, I have nowhere to be. I got nothing more important to do than do this right now. My goal is to turn this into a master class. Not officially, but I want everybody who's here over the next period of time to be able to really have clarity and understand what this looks like in your life. So what I'm gonna do is I'm gonna go through and I'm gonna talk about the different use cases on why people would want life insurance as an asset in their life. And then I'm gonna compare Index Universal Life versus whole life. And then I'm gonna talk about, we're gonna talk about savings, emergency funds, opportunity funds, real estate investing, retirement income, living benefits, all these different things. And we're gonna compare them apples to apples, where the risks are, where they're good, all that different stuff. So I'm seeing a lot of people here that are hitting 3. So that means you're looking at doing this for yourself. And so it's awesome. And so I would encourage everybody, even you guys, ask questions, like fire away. I'm an open book. My goal is I want everybody, agents and individuals, to really understand what you're getting involved with on both sides of the spectrum. And I know, obviously it's no secret, I lean more towards whole life, but I also think if you get whole life insurance, it's amazing if you do it right. And if you understand how to execute and implement it in your life, you are the key to that success. Like the product itself is nothing sexy. It's not gonna make you rich on its own. It's how you utilize and execute with it that's gonna matter. So Susan, you ask, in what situation could we design an IUL to beneficial to the client? Well, we're gonna get into that. That's a long answer. And so let's talk about this. I'm gonna go over here. I'm gonna go to my board, and we are gonna talk about different use cases. So we'll just say use cases. I just kind of talked about them a little bit, but I kind of want to walk through this a little bit and spend a little time on here. And so use case number 1 would be what I would call an emergency fund. I believe that we are too focused on rate of return as a country, as a culture, focused on Teresa, yes, we can help with that. And guys, what I'm gonna do, keep asking questions, keep plugging away. I'm gonna come back to this because otherwise I'm like a squirrel. I get totally distracted. So keep plugging away. If I don't get to you right away, I'm gonna come back to the questions probably every 10 minutes or so, and I'll come check it out. But I'm a big believer we need to be focused on financial structure. It's one of the reasons I created my Life 180 Pyramid Talk. And if you haven't seen it, I would say go watch it. But we need safe money first. You build this, your financial life the way that you would build a pyramid, right? And you build your safe money first. You build this foundation. And if we have the safe money built, the question is like, what is the purpose of this money and why do you need it? How much do you need? When is it okay? When is your foundation strong enough so you can then go build on top of it, right? That is the purpose. And I think the challenge is we're sold the story, the younger you are, the more risk you can take, when the reality is the younger you are, the less risk you have to take, right? Because we have time and compounding on our side. And if you understand the way compound interest works is what you don't want is you don't want losses. You want at all costs to be able to avoid losses and allow time to work in your benefit. When you lose money, you don't just lose that money, you lose what that money could earn for you moving forward. And so that's what the average rate of return is all about. And so just so the average versus actual rates of return, right? So this is something that people just kind of lose sight on a lot of times. They don't understand that the average rates of return don't really matter. So like, let's just imagine, I'm going to use an example just to show this. And this is why I think talking about average rates of return inside of investment portfolios should be illegal. Because if we had $1,000 and I'm going to use a really extreme example, but this principle, I encourage you to go and do this math on your own with smaller numbers over longer time frames. It changes the numbers a little bit, but the principle doesn't change. The concept doesn't change. If in year one, I lost 50% of, let's just say I had $1,000 invested in the market, I lost 50%, I got $500, right? Now year two, the market has an astounding rebound and earns 100%. I have to earn that 100% just to break even, right? And so I always kind of tell people math and money are different things altogether. They're not the same. And here's why. This is the reason I say that is because what did we have? We had a negative 50 year, negative 50, and then we had a plus 100% year equals 50. And then when I do that 50% divided by 2 years equals a 25%. So the average rate of return in these 2 years was 25%, right? But the actual rate of return, we started with 1,000, we ended with 1,000, is 0. Now, when you go out long periods of time, this is why the average rate of return in investments doesn't matter. I could show you how the S&P 500 since 1925 has averaged like 8.6%, but that's the average. But the real is more like 6%, right? And that just is what it is. So I'm a big believer that, and Warren Buffett says this all the time, if you don't have enough savings, you're not really an investor, you're just a speculator. And so by building this foundation here, that's what we're doing. We're just building our foundation so we can actually be an investor. So that way, if we build up like crypto, I love crypto, right? Like people like crypto, I get it. If you want to invest in crypto, but let's just say you go out and you take all this high risk on crypto, but you don't have your safe foundation built. Now crypto gets crushed, right? But like this is typically what happened. People do this. They build their life upside down, right? And they say, all right, I'm going to go invest in crypto. High risk, right? Half their life, or the crypto gets annihilated. You don't have enough safe money, right? And so what happens is your whole financial world falls over. That's the ultimate. This is America in a nutshell. They don't save enough. They go out and take too much risk too soon, and therein lies the problem. And so that is a big thing. So when we're talking about sorry, I got a little lost there. So when we're talking about what are the purposes, where do I have this? I wrote this out somewhere. Right here. When we're talking about why we want life insurance, emergency fund is number one. I think that is really, really important. I think an opportunity fund is the second reason. Because, Nelson Nash always says, when you have these policies in place, when you have your foundation built, opportunity has a way of tracking you down, right? And that is just what it is. And so when we think about this foundation here is that opportunity fund and emergency fund. So the question is, how much do you need? I think you need 2 years of income in this account. That's why that's why I'm so emphatic about what I teach. Why? I need 1 year for emergency and 1 year for opportunity, because when the economy goes through a down cycle, I don't want to be thinking from a scarcity mindset. I always want to be looking at the world through an opportunistic lens, and I want to make sure that my money is in alignment with my values and beliefs so I can actually execute in that way, if that makes sense, right? So we want emergency, we want it for opportunity. What if we need it for real estate? Which I guess could be lumped in to the opportunity. There are other people that would want it for business capital, like business reserves. All great use cases. Talking about retirement income. Okay. And then the last one would be like living benefits, I would say. Living benefits. And of course, I guess it's not benefits. Sorry, I can't spell. And then the last one would obviously be legacy. Can't leave that off of a legacy-based product, right? And so these are all things that I think are really, really important for people to understand. Like when you think about why do I want cash value life insurance, when we lump it all in, this is ultimately, these are the reasons. If you are thinking, I would ask right now, I'm looking at the chat for a second. If you are thinking about buying life insurance that is for a reason that is not on this list, please let me know, because maybe I'm, just having a mind lapse or something. I'm not perfect. Sometimes things escape me and just space out a little bit. But if you're thinking about a reason that you want life insurance and it's not on this list, or you sell life insurance for a reason that's not on this list, please let me know. And, I'll come back and I'll add to it. I'll integrate that into the conversation as well. Now I think what we need to do is we need to go through this list and we need to see which one, is better for IUL and which one is for whole life. Because when a lot of people go, Chris, when does IUL ever work? How can we design an IUL policy to be better for the client, right? Is there ever a case? I would say that no, there's not a case that an IUL ever beats a whole life insurance policy because, you're gonna see. So let's talk about emergency funds, okay? And I'm gonna try my best to keep this as organized as possible. Emergency fund. Okay, so on the emergency fund side, when we talk about whole life versus IUL, what's the most important part of emergency funds? We need liquidity. So the thing with an IUL is that there are surrender periods and that it is harder to have early liquidity. What you're gonna see with an IUL a lot of times is that the cash value, actually, you know what I'm gonna do? Is I'm gonna do this real quick. I'm gonna show you an illustration because I can. Hold on one second, I'll pull it up. I will go here. Let me get this pulled up. I've got my whole board here. Just gotta pull this up. And what I'm gonna do is I'm gonna get to a page where we can talk about this just a little bit. Cash value, accumulated value. So even in a good policy here, and this is interesting because this is actually not a horribly designed policy. So I'm happy to use this as an example, right? So, oops. So as we go through this, and I'm going to erase some of my things from a previous video on this thing. But as we look at this, you can see what's happening. Actually, I don't want to use that one. I want to use a different one. Hold on. I want to use something that's going to show the surrender value. Apologize, guys. This is the nature of being live, I suppose, right? I'm getting inspired and kind of doing random stuff. What page am I on here? 5. Let's go to. It's got to be here. Hold on. There we go. No, I guess that is it. Okay, I guess we're dealing with what we have here. Okay, so I'll go back. We'll go to this one. Okay, so I guess, yeah, this is the right one. So as we see this though, it just doesn't show everything. So the current scenario, which is not the guaranteed scenario, this is just the current assumptions, which is based on, I think, 6.4% internal return kind of deal. What I was hoping to see is a surrender value. Now what this is the cash value, is the surrender value in this policy. And so you see the accumulated value is always going to be higher than the surrender value. Now, the guy, whoever designed this policy, there's a gap here, $15,250 and $12,369. So what this is showing is that you've got that $15,250, but that's what's accumulating and getting credits, but your surrender value, what's liquid, is really only a portion, probably 90% of that $12,369, right? So that is the difference that I think you need to kind of take into consideration here. Oh, and hold on, I didn't have that on the board there. There you go. So you could see this, that is what's happening, right? So sorry about that, Maurice. Is that you have this here, since you didn't see it live, I'll do it again. The 15,000 is the accumulated value, but the cash value, the surrender value, is only $12,369. So there's this difference. Yes, your IUL is crediting and earning money on this $15,000, but you really only have access to this $28,676. And this is a, all intensive purposes, a well-designed IUL policy. Like this, as far as liquidity goes, typically what you'll see, and this is sad, but I see it way too often, is the fact that what we have is, like, normally you'd have the $16,421 premium. This $15,000 would be the accumulated value, and the cash value would be somewhere in the, like the 4K range, right? Like, is what it would typically be. And that's sad, because then that starts to build. But the surrender charges kind of get people stuck in these policies. So this is actually, all intensive purposes, is a pretty decent policy, right? Like, so that's important to understand. Now, what I want to do is bounce back over here. So when we're talking about emergency funds, I'm going to pop away from that. If anybody has any questions, let me know. But when we're talking about emergency funds, I think it's really important to understand, that, I gotta get to the bottom here. All these slides I've done. But when we're talking about emergency funds, I think it's important to understand that liquidity is everything, right? Liquidity, if we have the account value, accumulated value, liquidity isn't very good. You could see even in that example, I had 16,000, but it was 16,000 in premium, and only about 12,000 was liquid, and that's about as good as it's going to get in an IUL policy. With a whole life policy, I can show you how a whole life you can have over 90% liquidity year one, no surrender period, no surrender cycle, and starting year two, I could show you how whatever your premium is, you could have the cash value be growing by greater than the premium beginning in year two. It's almost impossible to do that in an IUL, right? Like, so when you think about the differences between the two, when we think about emergency fund, well, then whole life is going to win. When we think about an opportunity fund, obviously the goal is to build that as fast as possible. So once again, liquidity is what emergency and opportunity are all about. People that have access to capital are A, more protected in emergency, and B, more prepared and able to take advantage of opportunity. The more liquid they are, access to capital is king, all that fun stuff, and that is what it is, right? Like, so now we're dealing, liquidity. When we talk about real estate, this is another reason people like 1090 policies. I'm gonna get into the design stuff after, but real estate, I would say, there's several reasons that I want to utilize whole life insurance over IUL for real estate investing. Let's talk about that for a second, because I think this is a really big thing for a lot of people. So for real estate, what we're talking about is, let's use an example. Okay, so we want to buy a house, and I'm not going to talk about whole life insurance versus IUL for a second. I'm going to kind of set the stage here. What we have is a need. We want to buy a house. And let's say you want to buy a $400,000 house. And this house is an investment property. So you need 25% down. And 25% down on that would be $100,000. So I'll just do 25% down. Okay. And so now you'd need to get a mortgage for $300,000, right? If you want, you could obviously do more than $100,000, but we're just going to assume the rate here, right? So we're going to do $100,000 down, and we're going to do a mortgage for this. Let's just say, since it's an investment property on this assumption, let's assume it's an 8% mortgage at this point in time. And then the $100,000, now what we're doing is we're looking at where is this $100,000 coming from? Now, obviously you could pay cash, right? If you paid cash, the equity in that home, it's inefficient, because your house is not a great place to store your wealth, because the rental property is going to go up in value or down in value the same way, regardless of your equity. The only purpose of this equity is because the bank requires it, right? And I would argue, if you don't have a property that's creating enough cash flow to pay both, that wouldn't have enough cash flow to pay a mortgage on the full $400,000, you shouldn't buy that property. It's not a cash efficient enough policy to make it make sense. Anyway, yeah, so that rider is year one. So Julian asked about the illustration that I just showed. Yeah, there is a rider that you can do to use to accumulate money year one, and that policy actually has it. So it's happening, but there's still the costs and everything that go into it, and there are still going to be surrender periods. There are riders that reduce the surrender periods significantly, but they're still, going to be. It's still not going to be as liquid as a whole life policy. That's just apples to apples. That's just the way it is, and there's not really any getting around that. It's the dynamics, the nature of the intended original use of what an IUL was. It wasn't really designed to be a completely liquid thing. It's something that didn't exist initially. They've created those riders since then, but it didn't start with them. Somebody else said, does a monthly contribution to the life insurance policy affect your debt to income ratio when qualifying for a mortgage loan? No. Obviously you have to talk to your lender about that, I would say, but it's not debt, right? So you have to manage that. You're gonna talk to them about what you have for bills and expenses, but it's not gonna count the same way that like a utility would, or anything of that nature. And a lot of times, if you have a whole life policy, depending on how old the policy is, if you can show that, hey, I've got this premium going in, but that money is completely liquid, that can actually work in your favor, right? Like, so it's not a negative in most cases. But once again, I would say talk to your mortgage person. I think it's important to understand, working with a mortgage person that really understands this and gets this concept and how this can work, can make a difference in that. But there's no kind of hard fastened rule that life insurance has to go against your debt to income ratio, because it's not debt, and it's not payment on a debt, so to speak. And the premiums, when you design it the right way, are flexible in nature as far as the minimum and maximum that you could put in. And so, you have to take that into consideration. So once again, I would say you don't want to buy any house that you can't finance at 8% for the whole 400K and still be cash flow positive, right? Like, that's a big thing. You want to be cash flow positive. So the question is, what are you doing with this 100 grand? How are you getting the 100 grand? I would say saving money. Now let's talk, this is where the IUL versus whole life conversation comes in. So we got the $100,000, and then we have whole life, and we have IUL. We're just going to keep making these T-charts, and we're going to keep comparing them. So when you're taking this $100,000, what are you doing? You're self-financing, basically. You're basically saying, on this $100,000, on the first mortgage, think about it this way, and this is a cool concept to understand. On most places, you could go get a mortgage at 8%, and then if you were to get a second mortgage for the down payment, that second mortgage is going to be at a higher rate. It would probably be like 12% for the second mortgage. But if you self-finance it and you do the down payment, right now especially, the mortgage rate on your self-financed down payment mortgage, right, is going to be lower than your 8%. With both whole life and IUL, you're talking about, you're going to be in the 5% range-ish right now on loans for this. Yeah, so you're going to have like a 5% loan rate, and so that's less than your mortgage, which is a good thing. But here's the deal: we have to think about the fact that we are taking a loan, because remember, when you borrow against the policy, you're never borrowing from your policy, you're borrowing against the policy. You're never removing the money from your cash value. So if I have, cash value of 200,000, right? And then what I have is I have a net cash value column, and that number is going to be the same in a whole life policy. And then if I borrow and take a loan, right? Then that, let's say I take the 100,000, what's going to happen is this 200,000 is going to go to 100,000, right? Because I've taken 100 out of the 200. But here's the deal: the cash value, this 200,000, is going to keep compounding fully, right? Now, am I going to have a cost on this 100,000? Sure. But if I'm earning 5% on the full 200 and I'm paying 5% here, well then that's cool, right? Like it's kind of a wash loan, but you have free access to money. But the cool part is I could show you on paper how $100,000 compounding, right? Because if I have all 100,000 growing at 5%, a lot of people are like, why does that even make sense? Why would I pay 5% to access my own money? Well, you're not accessing your money, you're accessing the insurance company's money. They're using your cash value as collateral to give you this loan and to guarantee this loan on a guaranteed basis. That's what they're doing. But all the while, you're taking $100,000 and this is going to be compounding. But all the while, that 100,000 is still in there compounding, and the $100,000 loan is simple interest debt. So what does that mean? Let's say $5,000 compounding. So that means year 2 in a compounding account, you're going to have $105,000, right? So what I suggest to people and what I really coach people through is at bare minimum, you always want to manage the simple interest. 5%, you got $5,000. If you're doing a cash flow property, which is what you're going to be doing, you want to manage at least that $5,000. If you manage that $5,000, you pay that interest, the next year, what do you have? You still have a $100,000 loan. But the cool part is you're paying interest now, simple interest. Once again, you'll be $5,000 on this $100,000 that you have owed, but the account value that you borrowed against is going to be compounding now at $105,000, not $100,000. So now you're earning 5% on that, and you never interrupt the growth of this money, and that is the power of doing this. So all right, so let's talk about this. So okay, so hopefully everybody understands that. Now let me finish this thought. Somebody just asked a great question on what determines the compound interest on the cash value, and does it vary? I'm going to get into that in a second and do a comparison on a whole life versus IUL. But for the sake of this, I think it's important to understand the different ways that loans work with whole life and IUL. How I just described it there is exactly how it works with whole life. So boom, you have this understanding. IUL is a completely different animal. IUL loans, you have what's called a wash loan, which is how I described it, but there's extra risks that go into wash loans because your fees will compound against you. The annual fees, the net amount at risk of the policy will remain higher, and therefore as you get older, those costs compound against you. It's not the biggest deal when you're 30, 40, 50, but when you're 60, 65, 70, 75, those numbers start to add up a lot, and those fees that happen because of the wash loans on the insurance side end up being detrimental. Now, here's the problem and why I don't like using IUL for real estate loans the way that a lot of people say. And the reason I say you can't do infinite banking with IUL is right here. So let's just take that same example. I take a $100,000 loan. I'm paying a 5% index loan. Some companies call it index loans, some companies call it a participating loan. But the idea is you're participating in the index. And so you're going to pay this 5%, but you get to maintain the full participation in the index. So if like you're working on an IUL product that has like a 10% cap, the idea is that you could borrow at 5%, but you could earn up to 10% on that $100,000, right? So in theory, that looks really good, right? That seems really attractive because you could earn a 5% spread on your money. But the problem is you don't want to take risk inside of your policy. You want to take the risk inside of your real estate, right? Like inside of whatever it is here that we're doing up here for real estate, this is where you want to take your risk. You don't want to utilize your bank as the place that you're taking a risk. You want that to be your safe, predictable, guaranteed place that you know exactly how it's going to function, because as soon as you start utilizing risk inside of this tool that you're leveraging to be able to make your real estate asset more efficient, well, if this goes awry, you put everything at risk, and that's like the worst possible scenario. Does that make sense? And so what happens here is this seems really good that you have this positive 4% potential, but the problem is 25% of the time, the market is going to underperform the cost of this loan. And every time it does that, it is actually injecting more cost into this. And so instead of doing what we talk about over here and managing that accordingly in a whole life policy and knowing predictably what we have to do every single year, how to manage and make our real estate portfolio more efficient and grow faster and give us more control and help our money compound, instead of having that, we have a situation where we're injecting more risk and we can actually lose money and we can compound the fees. And as time goes on with these IUL loans, when you take loans and just read the illustrations, you're injecting a lot of risk into the policy. And from a real estate perspective, I don't ever want there to be risk in the policy. I'm taking enough risk in the real estate. I'm doing enough things, and I don't want that to have a negative impact on my real estate. Julian Diaz said on an IUL, you can also borrow as a wash loan, and wouldn't that be the same as whole life? No, it wouldn't. Let me explain. So with a wash loan, with an IUL, there's a thing called the net amount at risk. We call it NAR, is an abbreviation. And so the net amount at risk is basically so you have the net cash value, and then you have the death benefit. So it's the death benefit, I should have done it the other way, death benefit minus net cash value. Yeah, I'm gonna have to do this again. I did it backwards. So the death benefit minus net, oh yeah, that was right, net cash value equals net amount at risk. What does that mean? So let's say you have a net cash value of $200K and you have a death benefit of $1 million. Minus 200K equals 800,000, okay? So your net amount at risk is 800,000, right? If your net amount at risk is 800,000, yes, you're injecting more risk here, but the problem is, with whole life and IUL, with an IUL, this net amount at risk at 800,000 is getting more and more expensive, because when you're 40, you're doing an annual renewable term on $800,000, and you're going to have a premium cost that goes along with that, right? That is what it is. When you turn 41, it's an ART again, and if you have a wash loan, it's on the same 800,000, right? But it gets more expensive now, right? This gets more expensive because don't forget, on every illustration that you see, this is the problem. They run them with index loans and they show 50 basis points, 0.5% of positive arbitrage. So it shows your net amount at risk, this number, going down by 50 basis points of the cash value growth every single year. So as the annual renewable term goes up and up and up, it shows the cost of insurance going down and down and down potentially when you're taking these loans. But as soon as you do wash loans, you're never compressing this net amount at risk, and therefore the costs go up. Once again, when you're young, it's not the end of the world. When you hit retirement and you're taking income in retirement, and I'm going to get into this, I've done a lot of videos on this recently because I think it's so important to understand. It literally gets to the place where you're injecting so much risk into your policy that 2 to 3 negative years in a 5-year period, you can go from having millions of dollars in your policy to having your policy completely blow up. It's literally that drastic. And so wash loans, by the time if we're thinking about real estate and we're thinking about doing a mortgage and financing over a 10-year period, by the time you're 50, don't forget, this is all good. This death benefit is going to get more and more expensive. And it's just going to get more expensive, right, as time goes on. Whereas in a whole life insurance policy, this rate in your COI is fixed in whole life. With IUL, it's not. This cost is going to continually get more and more expensive. So you can't compare a wash loan in an IUL to the equivalent of a loan in a whole life policy, because the back end of the cost of insurance calculation is not calculated in the same way. Does that make sense? Hopefully. I don't know. And so you can ask to clarify on that if you need more. So I would say business reserves, once again, same deal. I think that's important to say. So let me go here. Hopefully, let me see if I have any questions here. No premium will not affect the debt. Okay, perfect. Thank you, Jose. It seems, okay, no other questions, good. So I think this is important to understand. And I think when you understand this concept, I think it'll change the way you think about IUL and about like what is the real intended use of it and does it make sense for you? I think this is going to help. So let's talk about the flow. Whoa, I got to zoom in. Let's talk about the flow of money. Okay. So when you have an IUL and I'm going to say for IUL. Okay, when you make a premium payment, so let's just say you pay, I don't know, you have a really efficient IUL contract. Let's just call it what it is. You have a really efficient IUL contract. You're working with an IUL agent that actually does it the right way. And even though I want to quantify and clarify that, I don't think there is a right way in your best interest compared to a whole life policy. But if you ended up with an IUL, let's assume it was the best possible way for you for an IUL. I guess that's a way to phrase it. It's like an $11,000 premium, and out of that $11,000 after the cost of insurance, $10,000 goes to the cash value. So what's going to happen is that $10,000 goes in premium, goes towards the general fund of the life insurance company. Okay, the life insurance, and this is premium I'm thinking about, not just cash value. So that general fund, the insurance company knows, well, our general fund is creating a percentage. So we're going to create, and we know that that general fund is earning 4.5%. So let's say 4.5%. So we know it's going to create 4.5%. And so we're going to take that and we're going to give that credit in the policy. And instead of giving it to the policy though, what we're going to do is we're going to create an options budget. Now, I think it's really important to understand here is people don't realize most of the time that you think you're invested in the S&P a lot of time. And some people know this, some people don't. But you're never directly invested in the S&P or any index. You're always participating in the S&P or whatever index through an options strategy. So that is the important thing to understand. You got $10,000 that goes through in premium. That money goes into the general fund. They say, well, we know it's going to be 4.5%. So we know that $10,000 is going to produce $450. And so rather than crediting you the $450, the way that a whole life policy might, right? And the whole life policy would go to $10,450.
I found this on the web.
Whoa,
we know
Siri's,
it's going to be 44.5%,
Siri's talking to me now.
So we know that $10,000 is going to...
I don't know why Siri decides to talk to me in the middle of my conversation. But we know in whole life insurance that $450 would be credited as a guarantee and a dividend. And that would basically take this $10,000 to $10,450, but that's whole life. That's not the way IUL works. What they do is they say, all right, with IUL, we're going to take this $450 and we're going to go buy options. And these options you're going to buy call options. And so how many options do you buy? Well, it just depends on the cost of the options. So there are so many variables involved in the success of IUL here and in your success. My challenge that I have with this, and I think it's so important that everybody understand this. So many people, okay, actually, I'm going to do this. Hold on. I'm going to do this. Hold on. I'm going to pull this back up. I want to show you this on an illustration. I got to find the right sheet. Sorry, it's going to take me a minute. Oop, I got to do this. It's going to take me a minute. I got to find the right page on this thing. I got to find the history, the index history of historical index performance. I think this is the page. Yes. Okay. So this is the part that matters the most, right? So I'm gonna eliminate this a little bit, here so we could talk about this. So what happens is people will talk about this and they say, oh, the illustration was run at 6.4% or 6% or whatever the number is, right? And so they look at this and they say, well, if we look at this and we look at the history of the indexes, right? We got the end of the year, the actual performance, and they do a look back and they can say, well, the 10-year average of the index was this, 15-year was this, right? Like, so we're illustrating you at 6.4%. Yeah, you lose the upside potential above maybe 10% or 12% or whatever the cap is. But what you do is you eliminate negative years too. And so you take risk off the table, and that's how IUL is sold. I always kind of tell people that this doesn't matter. The actual performance of the index doesn't matter, because if you understand what I showed you, it's the options budget, options cost, and you combine these two things, and that's what's ultimately going to set the cap rates, the par rates, participation rates, and spread charges. Remember, even in uncapped IUL products, there's always variables that come into play, right? Because there's always costs. Because I don't care what the product is, they're only participating in the market. You're not in the market, right? You're not in the S&P. You are participating in the S&P through an option strategy. The things that remain consistent and never change are these two things. You have an options budget and an options cost. Those two things combined together are going to create these variables. If you have a cap product, then those cap rates and the par rates are going to get manipulated. And if you have an uncapped product even, they typically have spread charges and participation rates in those two things. The company will maneuver those two rates. So for instance, they may say you have an uncapped rate, uncapped index, but they may say there's a 7 to 20% spread charge. Okay? If they say there's a 7 to 20% spread charge, and we look at it now and maybe there's a 8% spread charge, well, if the cost of options goes up and if the option budget goes down and all these things, this 8% could become 15%, right? Now, what does that mean? The spread charge is saying the first 7% the index does is kept. You don't get any of it. And it's not the insurance company is keeping it. It's being kept to mitigate risk and to be able to cover the cost of the options and all these different things. That's because that's the way that the options work. It's because they know that it's not going to pay out properly to manage it all. The life insurance company is not trying to get rich off this. And a lot of times the people think, oh, the life insurance company is keeping the first 7%. And so, but that's not the case at all. So I think as much as I don't like this product, I also think that part is misunderstood. So if they raise this spread charge to 15%, that means for the first 15% of positive return that the S&P 500 does, you're not keeping any of it. You know, you don't get any of that. The S&P would have to do 20% for you to get a 5% crediting in the S&P, in your index account. So when I'm talking about when we look at these numbers, right, and we look at the historical average and we look at the annual performance, and people go, oh, look at this. Look at how it actually performed. Look what the index performed. Well, I got news for you. Your policy being illustrated at 6.4% and then being sold that's a conservative comparison to the actual index performance. This 6.4 has nothing to do with the actual index. This is all an options return. It's called a hedging strategy. Read your illustrations and you'll notice the term. They're going to implement a hedging strategy using an options strategy, an options budget. And ultimately, you have to understand that's what's happening. You're never invested in the index. And ultimately, the performance of the index doesn't matter, because if we have a 24% return year here, like in 2017, 1 year, it's 24%, right now, let's say it's 100% participation rate. Okay, that's great right now, but if this happens down the future and that participation rate drops to 50%, which is possible in most of these situations, now all you got is 12%. Now in a big year like that, that's cool, but in 12% is still decent. But on a year where it's like 7%, 11%, if that participation rate gets cut, that has a big negative impact on what you have going on, right? Like, and so it's just important to know that the numbers here don't matter. There's always levers in place that the life insurance company can move to have a negative impact on the IUL policy. They're not moving these levers to screw you over. They're moving these levers because of math and the way that they're designed and what these policies are designed for. And that is what it is. So hold on one second. I gotta get back to where I am here. Apparently, I got a lot going on the sport already here today. It's all over the map. But so that, I think, understanding how the cash flow in IUL works, I think, is really important. All you're doing is taking the guaranteed crediting, that would be this $450, and instead of crediting it to the policy, you're participating in options and you're taking a risk. And they're not even taking massive risks. It's what they call a hedging strategy. So anybody have any questions about that? Does that make sense? And when you realize that, they're just taking more risk. In an IUL, within the illustrations, they show perpetual growth. They show positive growth every single year. The reality is it's not going to perform that way. And every year in real life, which is 25 to 30% of the time, that the market actually performs worse than is illustrated, that's actually increasing the net amount at risk, and it's making the IUL play catch up compared to the illustration. That's one of the reasons I created the IUL challenge, because these policies never perform according to the way they're sold, because they can't, because 25 to 30% of the time the market performs worse than illustrated. Therefore, now it's got the problem and the costs and the fees and the expenses, all these things snowball against it. And by the time you go to have to use it for retirement, or like a lot of times people think IULs are great for kids because you got more long-term, more longevity working ahead of you. You got more long-term for these fees and stuff to build up against you in a way that was not illustrated. That's what I would say. Once again, you don't ever want to take risk inside of the insurance policy. Like let's talk about that philosophically for a second. Life insurance companies do one thing, and they do one thing better than anybody else, is that they manage risk, right? And so for me, when the nature of an IUL, the nature of the way IULs are sold is the upside potential, downside protection. They tell you that you can get 6.5% return, 6% return, it's conservative, it's safe, it's this, it's that. If it were that predictable, that safe, then life insurance companies would figure out a way to get that safe return in their general fund on their own without you. And if they can't get above 4.5% in their general fund without all the cost of insurance and fees and all that stuff, how are they going to do that for you on a predictable, safe, guaranteed kind of quote unquote basis, right? Like, it's just, you use common sense and you reverse engineer this and you realize, oh my gosh, like that's not it. It's not for me. It's not going to work that way. Like it's just logical that it's not going to work. When you work with an IUL company, typically speaking, most IUL companies are stock companies. The alliance and allegiance to a stock company is to the shareholders of that company to create profit. When you have an IUL, when you put money into an IUL policy and you put it into the general fund to get an option strategy for the stock company, they have to move their spread charges accordingly to make sure that they remain profitable as a company, because their alliance and allegiance is to the shareholders, not to the policyholder. That's a danger. And I would argue, even with a mutual company, if you work with I'm not going to name names of companies, but there are some participating mutual companies that have both a decent participating mutual whole life insurance policy, and they also have an IUL. If you're with those companies and you have an IUL, those mutual companies, their alliance and allegiance is to the policyholders that have whole life insurance policies. It's called a participating whole life insurance policy because as a policyholder of a whole life insurance policy with a participating mutual company, you are effectively a shareholder of that company and you participate through the payment of a dividend in the profitability of that company. IULs, even with a mutual company, don't get that benefit. They are a profit center, and that profit center will end up propping up and supporting the guarantees that they have to meet on the whole life insurance, right? So that's really important to understand. When you understand the flow of money, how it works, the principles about how life insurance companies work, and you understand like the long-term impact that life insurance companies have had in the financial industry and what their specialty is about mitigating risk and managing purchasing power, giving you the best possible return with the least risk possible, that is their focus. So why am I going to try to take a company that's got 200 years of success, doing something right, doing it better than any other, quite frankly, in companies or kind of institutions in the financial industry have done? Why am I going to try to take a company that focuses on that safety and security and guarantees and all that stuff and try to get them to inject more risk in an area that they don't even do for themselves? It makes no sense. If I want to take risk, and believe me, I'm all about risk. I used to play poker for a living. I still play poker a lot. I love risk. We're going to talk about this, Trin. Stay tight. Don't go anywhere, because you and I are going to have a conversation about this. And as I'm answering this, anybody else here that thinks that whole life is more expensive than IUL, raise your hand for me. Put a 4 in the comment box if you think whole life is more expensive than IUL. Do that, and we'll have this conversation. But what I would say is, if you think life insurance companies are going to help you get better returns, I think you got to really think about what you're doing. I would say you have to take risk if you want to achieve anything significant, but I think you need to take risk in the things that you can control. And you just can't, you don't control the variables of the policy, right? You should take risk in things like business and real estate and other assets that you have the ability to, that are in alignment with your unique expertise and abilities and passions, and the things that help you become more so you can accomplish the life that you want to live. And that's why I love whole life as an asset foundationally. And the reason I don't like IUL is because there's risks in that IUL policy that can actually become problematic to you showing up as the highest version of yourself, right? So philosophically, that's a big deal. Okay, so as we do this, so somebody said whole life insurance is expensive. Let's have a conversation about this. Compared to what, I guess is what I would say. I'm gonna pull this up. I'm gonna get an expense report out, and I just wanna use this as an example. I gotta find the right page here. Let me see if I can find this. Nope, that's not the right page. Got a lot of pages on these IUL illustrations. Loan ledger, nope. I guess I should have pulled up the loan ledger when I was doing the loan thing just to kind of prove a point. All right, so policy credits, charges, loan charges, policy charges. Okay, policy charges, interest crediting, cash value, premium outlay, cost of insurance. I want to see if this, I just want to make sure I have the right policy fees, premium charges, rider charge. Okay, so yeah, this is going to be a good one. So what I'm going to do is I'm going to erase some of this just to clean it up real quick. Sorry, once again, I was not completely prepared to go through all this, but we're going to do it because I think it's important. I'll do this and we'll just start from scratch, and we'll probably shift the conversation a little bit. But I think it's really important to understand this, because I think this is one of the most misunderstood elements of whole life insurance versus IUL in the industry. And we're going to go back to this. We're going to go back to, hold on a second here. Why is this not working? Okay, I got to make sure I get everything. I want to make sure. All right, we're good. All right, so we got this figured out now. Sorry about that delay, guys. No, so Trin, here we go. This is, all right, this is good. This is gonna be fun. So here's the deal. This is the reality about Index Universal Life. It's annual renewable term. So the idea, I'm gonna pull this aside here. I'm gonna go back to the board here and we'll get to it. So the idea, how people with IUL, they say we're gonna do option B, which is increasing death benefit while you're funding, right? Because what happens is that allows you to put more money into the policy. And then as soon as you stop funding, they go to option A. And the idea is when you go to option A, it levels the death benefit, and the net amount at risk theoretically shrinks reducing the premium cost. So as you get older, hypothetically, that's supposed to work, right? Does that make sense? That's ultimately how this is supposed to work. That's theoretically how people want to do it. The problem becomes is that, first of all, when we hit older years, when we're in retirement, the cost of insurance doesn't get compressed, because what happens is you switch to option A, and then what do you do also in retirement is you take income. Now when you take loans against this, and then you take into consideration down years in the market and how the fees are compounding against you, and in down years, and it actually multiplies and amplifies the problem, your net amount at risk doesn't actually shrink when you're taking loans on negative year for income. You actually wind up with a problem. Now, with that said, what do we have here? We have somebody, I just want to use this example. We have somebody who's paying $16,000 starting really young, right? And they paid for 10 years, and they had, you could see the policy premium charges for the first 10 years were what they are, and then they drop off, there's no premium charges. But then this company, their cost of insurance and their rider charges are kind of, they lower their cost of insurance, but they cover the cost of insurance through a rider. This is pretty common. Different companies do it different ways. But the idea and the principle of this is going to be the same pretty much across the board. And by the way, this is the Allianz Pro Plus Advantage. This is the #1 sold IUL product in the world right now. Like this one product that I'm looking at. So I need everybody to understand this. So is whole life expensive compared to IUL? Here's the deal. Actually, I was gonna just talk, but now I'm gonna write. So here's the deal with whole life. When we pay a premium for whole life, so whole life, we have year 1, we have year let's just say 80 of a policy, and we have money, right? So what's happening is when you buy a whole life policy, you're buying a level premium effectively. Now it gets a little more expensive as it goes on, but it's gonna go up a little bit every year because they'll annualize it based on the amount of time that you want to pay the premium. If you have a full pay policy, it'll endow at 121, and that's kind of how they do the cost of insurance, where the cash value and the death benefit will match up at this number at the end of life at 121, and that is what it is. And other policies will work where you can take all the fees and the cost of insurance and have them paid up at 65, right? And so at 65 years old, right? And so this is age. I'm just going to eliminate that. So 80, it's 121. And so at 65 years old, the whole life policy can be completely paid off, meaning anything beyond 65, there is zero insurance charge. Zero. It's all covered before the age of 65, right? And no matter what, I'm going to make, Jose, the replay is going to be available on YouTube. I'm going to put this all up as a live replay. Anybody can watch it. Maybe you're watching the live replay now after the fact. I don't know. But you can pay up. Whole life can be paid up. This is the difference. And anybody that tells me whole life is more expensive than IUL, you just have a lack of understanding about how IUL works. Because what happens is, now we're going to go over here, IUL, I'll say this, for the first period of the policy, IUL is cheaper, right? Because we're going to look at this and we're going to say, all right, all in, you're talking total policy charges for the first 10 years, $22,000. Then you can look at it over the first, 25 years of the policy, and you can see it's $39,000. So during the first 25 years, the policy is going to be a little bit cheaper, right? It is going to be cheaper than whole life. I'm not going to argue that, but listen, you're not buying IUL or whole life to solve short-term problems. We're always looking to buy these policies for long-term strategies and solutions. It's got to solve our problems long-term. I don't care what an IUL does for me right now and over the next 20 years. I care what it does for me when I'm 65, when I want to pull income from it. I care about what it does when I'm 75, when I need the living benefits and when I need access to the cash still, my income still going through and making sure it's there for me for the rest of my life. That's when I need IUL to perform for me. So many people focus on the benefits of IUL, what it's going to do for you and how cheap it is right now. They don't talk about the danger of it, because when I'm in a whole life policy, I could be paid up by the time I retire at 65. All my costs and fees and expenses can be completely gone, and I could reap the rewards of all the benefits. With IUL, I still have an element of risk that I haven't dealt with completely. So now you can see age 42, policy year 25 in this scenario. We're going to go to the next page, and you can see now the costs start on the total policy charges start going up, and they go up, and it's still not horrible. But what are you doing here? Now, typically it's going to be about 65. This is going to be the year that you start pulling income and start doing things where you're starting to leverage it. Now, if you retire at 65, I don't know, but if you know this, but there's about a 25% chance you're going to live to about 88 to 90. If you are married and both you and your spouse retire at 65, you have a 25% chance one of you is going to live to 92. That is just the actuarial math at this point in time, right? So these are things that we have to consider. And so remember, what did we have here? This person had total premiums of $164,000, okay? Total policy charges. By the time they're 92, $781,000 in total policy charges. Now, if I go back here, let's go back here and look at the insurance and think about the time value of money. I don't remember what the total death benefit was at the beginning on this thing. But we're looking at the gate because it was an increasing death benefit. So you had an initial death benefit right here of $515,000, okay? And we ended up with $784,000 of I'm losing where I am here because I think it's right here. Yeah, $781,000 of total policy charges. I can promise you that whole life insurance is a fraction of the expense of an IUL. Not if you live the next 15 years and you die early and whatever. So I can't show you the fees and the charges of a IUL. Here, I'll tell you what, give me 1 second. I'll pull up and I'll share my screen. I'll pull up a whole life illustration. I just got to find an example, and I got to run a test case that doesn't have somebody's name on it. So give me a second. If you guys bear with me, ask questions, whatever, I will come back to checking all this out in 1 second. Is everybody finding this helpful? Or am I the only nerd that cares about this stuff? I mean, you're all here still, so I guess you must care a little bit, right? Let me I'm going to find an example. I'm just going to do a policy on myself and just kind of show an example. So I'll show like a 43-year-old male. I'll show you how fast and easy this is here. Well, I don't know how fast and easy it is, but I'll do something kind of dumbed down and simplified just to keep the concept going. Can send your, can send your, I'm not sure what that means. No, so you cannot, you can't pay up your whole life policy. You can't pay up a whole life policy before you're 7. I think that's a really important thing to distinguish, actually, and I'll talk about that here with a whole life policy. But I gotta get this set up for a second. So I apologize once again. This is live, so it's obviously not as efficient as I try to keep my regular videos. But we're just gonna roll with this. One of the things that I think is really important with whole life that I love to do as well is focus on like the ability to front load money into a policy, right? I think that's like super powerful, like the ability to do that. If you take somebody that has I don't know, like money sitting in a bank account, money sitting in CDs or bonds, and they want the guarantees and the safety, but they want the liquidity and everything that we could do inside of whole life insurance to leverage for real estate and for reserve accounts for your business and all that stuff. This is one of those things that I think is really, really powerful. So I'm running these illustrations right now just to kind of get into it, so I can walk you through an example of an illustration, just to kind of show you what the options could be. And I'm trying to make it efficient, and I keep meching it out. So I'm gonna try to get it as close as possible here, because I'm obviously rushing this, and I'm not being super diligent on making sure all the details are the way I need them, but I can get it close enough. That I know. I'm just gonna give it another shot here and see what happens. As it's doing that, let's see, what do I have for questions? Okay. I can't design an example for an individual right here. But what I will do is I'm happy if anybody wants to get a hold of me and you want personalized illustrations made for you and you want to take a look at what it looks like, I'm happy to have that conversation with anybody. All right, so let me see. I got to get this moved over to the right monitor. I got to do this, and I got to go. Hold on one sec here. Sorry, I'm trying to produce this all on my own here, and I don't have anybody helping me today. I'm just kind of trying to make all the technology work for myself. Here we go. So that's my screen. I got this figured out. Okay. So this is just a company that I like to use, Lafayette Life Insurance. Great company, great Comdex rating, great ratings across the board, great financials. They're just a really good company. And I love their simplicity, their transparency, in what they do. I like a lot of what they do. There's other companies I like. There's other companies we do business with. I'm not saying this is the only company we do, but just for the sake of conversation, this is just a good company to use. And my computer's bugging out on me. Unfortunately, I have a connection that gets a little wonky. So hopefully it doesn't mess up the connection with sharing my screen too much. But let's do this. Somebody asked, Can I share the fees and the costs? Best way to get in contact with me for illustrations. So the best way is to go down and set up a clarity call, and then have a first call. And because we don't just do illustrations without having a conversation, because illustrations have to be designed to meet your goals and objectives, and it's not as simple as just looking at the math, right? It's not just a spreadsheet and being like a 1090 policy. It's about really understanding your short-term goals and needs, your long-term goals and needs, and what the rest of your assets and financial picture looks like, and then designing a policy to really cater to that, right? To really support both the short-term needs and the long-term goals and objectives, and making sure that you're using this asset to take advantage of the full power of everything that it can bring to the table for you and your personal finances. That is what this is about, right? And so, anyway, I hope that helps. I'm not trying to evade, obviously, and our team, we're able to make illustrations for everybody, but I do require a conversation first, because it's very personal. And I think one of the challenges is in this business, and there's some influencers online, and I'm not going to call them out, but I think they spreadsheet this too much and they commoditize this product too much. And this product is anything but a commodity when you use it in your life. You have to think about it in different terms. And so this is an illustration. Once again, not like necessarily the maximum optimization, because I just kind of threw it together, but it'll allow us to have a conversation, right? Now, here's the deal. When I showed you that IUL, it showed vanishing premiums. It's important to understand that in an IUL, you can have quote unquote vanishing premiums, in a sense that it can show it so you're not paying the premiums, and you don't see the cost of insurance in the illustration, but you never can pay up the illustration. With whole life insurance, I'm funding this every single year, and as the policyholder, I'm in full control. So Julian, I'd have to, like, every policy is a little bit different. Sorry, I got distracted from the illustration here. I just saw Julian's comment. I would have to look at your illustration. If you want to show me your illustration, I would bet that, and I'm happy to look at it for you and give you some feedback. But I would bet I find other elements in that. If that's the case, there's usually other things that are happening in the back end of everything. But anybody that has an IUL, by the way, or you're looking at an IUL illustration, it's another thing I'm happy to do. I'm happy to give an evaluation. That way you can go through the IUL. You could decide, oh, Joey, awesome that you have a clarity call. Fantastic. But if anybody has an IUL illustration that they want us to evaluate, I'm happy to do that too. That way you at least understand what you're buying. And if you still like it at that point in time and it makes sense and it's within your risk tolerance and everything, then God bless you. Go forth, have fun. Good luck. It's just nothing I would personally do when I compare IUL to whole life. There's a reason I transitioned all my IULs to whole life policies in general, but I'm happy to kind of give feedback and even do a Zoom meeting. And you know, if you just email it to me, I'll do a little preparation, do a Zoom meeting with you, and like go through your illustration with you and really let you understand what you're involved with. So okay, getting to this policy though, I think with IUL, a couple things I want to talk about. It shows vanishing premium. Remember the last illustration it showed after 10 years, it showed no premium coming out, but that doesn't mean there are not charges in the background working. With whole life insurance, it's going to show me making premium payments, but I always have the ability to do what's called a premium offset, meaning utilize the internal fees and partial surrenders of the policy to pay for the premium. So after year 7, I could actually anytime pretty much that the policy is funded properly in this policy, I could probably start doing a premium offset at year 5, maybe at year 6, which would be having the policy pay for itself, which would be a very equivalent but more predictable way of going about the same way an IUL does, vanishing premiums. But you can also do what's called a reduce paid up, meaning reduce the death benefit, fully pay up the policy, eliminate all the fees, and have the cash value keep growing. I don't do that because when you do a reduce paid up, you know, it's just, I don't know, you can't reverse it. If you do a reduce paid up, you can never go back and keep contributing money to the policy. And I never, you know, the way I look at it is once you get to year 7 in these things, you know, I'm putting in $10,000 a year and the policy's growing by $13,000 a year almost. Like, I can't think of another place in the world that the asset is going to be any better than this. And this is a good blend of a policy. I did a $40,000 front load with a $10,000 a year premium. And you can see here, we got over $46,000, you know, net cash value year 1, and there's no surrender charges. That's, you know, after the cost of insurance and fees and all that stuff, like that is just what you have. And you can see year 2, I'm paying $10,000 in premium. I'm growing, and this is not even optimized. The policy is growing by more than what I'm paying in premium. Like you just can't accomplish that in an IUL. Like it's impossible to do that on the net basis, after surrender charges, after all the fees, after all the things that they take into consideration. And so as you go through here though, a lot of people are gonna say, well, Chris, you don't, like what are the fees and everything inside of a whole life policy? Well, first of all, we utilize a term rider in whole life insurance in this. You're gonna see the death benefit dropped off here. The term rider drops off, so that's where the insurance part drops off, but you're gonna see because we're using paid up additions, which is utilizing the dividend to buy paid up additional insurance, the life insurance is gonna continue to grow as the death benefit, or as the cash value grows, right? So that's important to understand. And you can see that this gets bigger and bigger and bigger. And once again, I didn't optimize this for death benefit, I optimized this for cash value with the least death benefit as possible. If you have more of a need for insurance, you know, then you know, it's something to consider that you'd want to supplement your bigger insurance need with, you'd want to supplement that with term insurance. I'm seeing Jose Antonio Rodriguez, your comment now. You have an IUL that you purchased at age 31, you still have it. I'm now 57. Jose, I would be fascinated if you would be willing to share if you have the original illustration with that, and then we could run an in-force illustration about what your situation is, and we could do a case study on what that looks like and how is it performed compared to what you were sold. what has been the performance like, and ultimately what is the actual performance of it, and how would that stand the test of time compared to a whole life insurance policy. If you're game to that, I'm always looking at case studies. I'm always looking at people that are wanting to step forward. If you're willing to be a case study, I will take the time and educate you, and you can kind of have more clarity about what you have going on. So that's kind of a win-win-win scenario. If you are interested in that, just email Chris, C-H-R-I-S, @life180.com, and we can connect. I think that would be fun. I'm a total nerd for this stuff. I'd love to do that with you. But you can see here, so a lot of people say, what are the internal fees and expenses? The crazy part is, a lot of people say, well, IULs are more transparent. And they say that because they say, well, if you look, you can look at the page that shows all of these fees, right? All of these, all the expenses. I'll pop this up here, right? I'll come back to this illustration. This is back to the IUL illustration. This is the Allianz Pro Plus Advantage, right? So a lot of people are like, oh, IUL is so much more transparent because of this, right? They show you all these fees and all these things, and all based on the current scenario. That's what they say, but really they're not doing it for that. They're doing it for this. They're doing it to say these are non-guaranteed values shown. Coverage is subject to the terms and conditions of the policy. The assumptions on which this illustration is based are subject to change on an annual basis. Meaning they have to put this in here. They have to put this in here. The disclaimers and disclosures to say that these are all the fees that currently exist, but these fees can change and we can change them at our disposal, and it is up to us and not you, and these can get worse than this, right? Like, that is ultimately why they have to be transparent about the fees, is because they're variable. That is the key. Now, when I go back to the whole life policy, that conversation changes, right? Because they don't have to break it down on a case-by-case basis, because when you look at the net cash value here, in this column right here, when we look at this number, this is net of all fees, expenses. There's no variables. Those fees cannot change. Those are fixed. The only variable that can change here is the dividend payout. And you see here, everything else, the non-guaranteed assumption is assuming 100% payout every year of the dividend. Now, this company has always paid a dividend. It's never missed a dividend payment. And when you look at that, and you look at the fact that dividends today in 2023 are the lowest they've been in 80 years, if we look at that assumption at 5.2% is what the dividend is being illustrated on this. It's the lowest it's been in 80 years. Now we're looking at that being like, all right, I can look at this pretty comfortably and realize the interest rate environment we're in, and there's no guarantees, but I personally, if I were buying this, I'd look at this and be like, wow, there's a chance that this policy is actually gonna perform better than what I'm seeing. And the reason is because as the fixed interest rate environment goes up, the dividend rates will go up, and that will be directly related in the policy. Because remember, as a policyholder with this policy you're looking at right here, you are participating in the profits of the company, and therefore you will share in that through a dividend, versus with an IUL, you ride the waves of all the other variables, and they have to move those costs around to protect themselves and to protect the shareholders. With a whole life policy, you are a business partner of the policy, and it's huge. To really understand that that's the case. So the fees are not going to be as transparent and broken down column by column, thing by thing. But the good news about this is that what you see is what you get. There's no other variables in cost of insurance and admin fees and all this stuff that can be used or manipulated or changed to rock this off its axis, right? To knock it off this. The only thing that you have to be concerned about is what's the dividend rate going to be, and are they going to pay it? And that's why it's important to work with a company with a good balance sheet, to work with a company that has a good Comdex ranking, and to work with a company that has never missed a dividend payment as a mutual company for at least 100 to 120 years or more, right? So if we have companies that have done that and shown that track record of success, well, that's what it's all about. And if you can do that and get it right, like, that is a total game changer. And so you can see this moving forward. It changes everything. 2 to 3 other companies we use. So I don't get into a lot of companies. I'll tell you I work with companies. I'm not going to tell you which ones I prefer, because there's like some compliance rules about companies and all that stuff. I mean, Lafayette, I'm not going to hide. I have a couple favorite companies. Lafayette is one of my favorite companies. And like I said, the only reason I'm showing Lafayette right now is not because I prefer Lafayette. It's because their illustrations are the cleanest, right? Like, and if you know me and you know my content, I hate selling off illustrations. But I think, for the purpose of education and when we're talking about understanding the different columns and what they mean, I just like Lafayette as far as educational purposes. I like them the most. I also like them as a company a whole lot as well. But I would say Lafayette, One America, Guardian, Mass, Penn, we work with all these companies. Everyone has their own sweet spot. Everyone has their own ability to do different things. But I'm not going to get into individual opinions on all the different companies. That I will say. I will say One America. I will get into not my opinion about them, because obviously if I get into opinions, think about it this way: if I get into opinions on YouTube about my opinion of every different company, think about what that's going to do to me. I just ask you guys all to use some disclosure, or I don't know, courtesy. If I start ripping on all these companies that I'm contracted with and that we do a lot of work with and whatever, I will say this: every company has their own benefits. Every company has strengths. The reason we work with the 5 companies that we work with is because every company has a different fit for different needs for different people. Like some of them are more of a base company that we work with, that we start with, and some of them solve different needs for different unique circumstances and situations for people. I think it's important to not just work with somebody with a captive company that only sells like New York Life or Northwestern Mutual or something like that, because they are captive and they have to only sell those companies, and there's no way one company does everything well for everybody. So I think that's important to understand. But I also, sometimes one company is good for like a base person, versus like, you have different situations of really unique funding needs, different flexibilities, different riders, different time frames, different ratings. Different companies handle different health ratings differently, and they do different underwriting. And understanding the nuances of all of it, that's why we work with the 5 companies that we work with. And and listen, I'm happy to answer if you have any technical questions about, all right, is this company direct recognition or non-direct? How does their loan work versus not, or any of that? Like, I'm happy to break that down and get into technicals. I'm just not going to give my opinion about the companies themselves as a whole, because it's just not a fair question, because it's going to be different depending on your situation, right? Because I love all the companies. I wouldn't be working with the companies that I work with if I didn't love them in one way, shape, or form, right? Like that's the biggest thing I could say. All right, so what do we have here? Man, we're going a long time here. Hour and 42 minutes. Let's roll. Let's go here. So what are your thoughts on limited 15-year whole life policies? All right, so that's a great question. So there are all sorts of limited pay policy options. The limited pay policy options, you can get a 10 pay, a 15 pay, a 20 pay. Some of the companies, like Lafayette, the life insurance policy I'm showing you right now is a limited pay to 75. Some companies, a pure whole life insurance policy full pay is like pay to 120, pay to 100, pay to 95, pay to 75. One America has a policy that pays at 65, the select policy. And that when we say pay to 65, that means it's fully paid up, right? You don't have anything else after that that you have for expenses. My thoughts on the 15-year policy is it depends on you. It depends on your age. It depends on your objectives. I think they absolutely fit a use case for the right person. I think if you are somebody who is, say, 50 years old and you say, I want to retire at 65 and I want to be done paying premiums at 65, and I'm not going to have cash flow, and I'm not going to have real estate investment cash flow that I'm going to use a policy for to invest in or anything of that nature, and you just want to be done, a 15 pay is great. I don't like 15 pays or 10 pays or 20 pays or any kind of limited pay on younger people, because the most powerful part of these assets as a whole life insurance policy, when it's used the right way, is that it gets better and better and better and better as time goes on. Okay. And so when we look at that, why are we going to stop our ability to fund that when we're young? right? So 15 pays are great if you're older, 10 pays are great if you're 55 and want to stop at 65. But I say, if I'm 30 or 40, I'm 43. So at 43, I'm never going to buy a 10 pay because I want the flexibility and the control on my end. If I buy a 10 pay, I'm basically saying to the insurance company, they have the ability and it's going to happen. It's fact, contractual right that I'm no longer allowed to pay into that policy after 10 years. And that is just what it is. So at 10 years, I want to make sure I have the ability to keep funding that thing if I want, because at 10 years, there's not going to be a better asset in the world to keep contributing to. Remember, as a long-term asset, if everybody had the ability to buy a whole life policy and reap the benefits of it and the efficiency of it, starting in year 7, 8, 9, 10, it'd be the most popular asset in the world. But the problem is people don't think long-term enough. All they do is they look at the first 1, 2, and 3 years and they go, ooh, wow, that's gross. Like I'm gonna not have as much cash available as I put into it. They don't have the ability to think long-term. So, so if we know that's the case, why do I want to stop my ability to put money into something that would be the best asset in the world if I were to just start it up at that time? Like when we back it out and we use common sense and think about it logically, we realize that, we wouldn't want that kind of limited pay, right? Like that, I think that's important to understand. So I hope that makes sense and that answers your question. So somebody said, I'm just going to go through the notes here. So Jose, amazing. You pay $99 a month. Your wife has one too. She pays $60 a month. I'd be really curious to see the original original illustration. Get an in-force illustration currently of the same product. We can compare the two against each other and we can evaluate and do an assessment on what this thing has really done. And honestly, we can take a look and see what it will look like for you moving forward. Make sure that you're funding it according to what it needs to be funded at right now, to make sense, to make sure that you're on the right path to meet your goals and that this thing is actually doing what you think it's doing and what you need it to do for you. And that's just something that I'm happy to do for anybody that's in that situation. And honestly, I'll redact your information. We'll do all that. But, the only thing I ask is that if we do it and we add value and you got it, you're okay with me making a video, as a case study to use it as an example. And that will make it worth my time to kind of put the time into you and to provide you that value. And so hopefully that makes sense. So let's do this. I want to go back to the policy and probably wind this up here shortly because I've been going for a while now. But when we look at this policy, this is the whole life policy. Remember, all this has been paid up. Remember, on an IUL at 75, because this policy is fully paid up at 75 years old. With an IUL, all these years, when people say IULs are cheaper than whole life, IULs would still be having premium expenses and charges and annual renewable term cost of insurance, age 76 and beyond. I got news for you. At this point in time, if you have an IUL, you're going to be taking income from it. You're going to be having more risk due to the policy loans, and you're going to be having higher net amount at risk and higher insurance charges every year. Those things are going to be racking up and stacking up against you, whereas your whole life policy, there's nothing here. You could look at this and be like, all right, I got $700,000. It's kicking out net increase in cash value of $27,000 a year. If you wanted to basically take, $27,000 a year forever, you could. You could do a lot of different things in this situation, right? And you can do that all more predictably because you don't have all these other fees and charges running in the background, creating more risk and injecting more risk into the policy and into your retirement plans. That is the biggest difference, right? So once again, it's not a matter of what's the policy going to do for me over the next 20 years. It's what's it going to do for me when I'm in the time frame that I'm buying the policy for, i.e. retirement income, right? I.e. what about the living benefits and all these different things? So speaking of living benefits, let's go down here and let's talk about living benefits, the accelerated death benefit plus rider. So you can see if you become chronically, terminally ill, we have access through periodic payments or lump sum payments. And so, if you're 65, and I talk about my father-in-law and his story about, pancreatic cancer and all that stuff. Yeah, absolutely, Jose. Fantastic. But I talked about my father-in-law and pancreatic cancer and having access he had a terminal diagnosis. He was given, 90 days to live. Full transparency, he didn't have a Lafayette policy, but the equivalent here, right? If he had this policy, hypothetically speaking, he was 72 years old, he would have had access to a $654,000 lump sum payment, and he could have taken, he'd still have some death benefit left over, right? Like, and he could have even taken periodic payments. I don't see which one is the periodic payment. Oh yeah, so he could take in smaller payments of like $392,000 if he wanted to. But at the end of the day, like we're looking at this, and he's got access to all this money if he needed it in case he wants it for his medical directive. Remember, medical bills are the number one reason in retirement that people have to file bankruptcy. They eat into their retirement plans. Your 70% chance to need long-term care or assisted living before you die. So when you think about it on those terms, like this becomes a no-brainer. A lot of people, like Dave Ramsey says, whole life insurance is horrible because, why not just self-insure once you hit retirement age? Well, that's great. You don't have any other liabilities, but you definitely, even if you don't need the death benefit, you're going to want the living benefits of this. You're going to want the protection of this, the insulation of this. You have access to the cash value if you need it for retirement, but you also have access to accelerating the death benefit on a tax-free basis to manage your medical directive and pay medical bills, deductibles, anything of that nature. And if you unfortunately are diagnosed with some sort of catastrophic terminal cancer and you decide that radiation and chemo and all that is not for you, which is kind of the way I look at the world, I understand that's not everybody's take, but that's my take, absolutely. And that's why I have a policy that's designed just like, I think it's important, I would say, for everybody to have a policy just designed, for medical benefits, right? To make sure that you're protected, to make sure you're protected in retirement, and make sure that all that is good. Here's my email address right there. If anybody wants it and needs anything. Whole life average return was between 2 and 4% compared to IUL at least 6%. Trend, it's not the case. It's just not the case. Show me an example of an IUL actually performing at 6% trend. I don't care about the illustrations. I care about real life. Furthermore, just show it to me. Just show it to me. Actually performing that way. So if you tap into living benefits, it does affect your cash value. Absolutely. Yes. But I would argue you can accelerate the death benefit, and the living benefits are going to be more than your cash value. And so you would accelerate more, and then you have more control. It's just going to be more flexibility at that point in time. So it's really, really powerful. And what it can do for you is once again, it's about control, it's about options, it's about flexibility, and utilizing this asset as a way to help you solve different problems at different stages of your life. So think about it this way. I'm going to go back up here, and this is what I'm going to end with, but I just did a video that's coming out on Sunday. I would suggest everybody mark it and go from there and watch the video. But I want to go through one more thing here that's going to talk about the power of whole life insurance, and then we'll end. But I got Trin here making another comment. Let's see. From Google search, whole life basically gives you less than the rate of inflation. Okay, that's great. I don't know where you're Google searching or where you're getting that information, but it's just not accurate. So I don't know what to tell you, Trin. I'm happy to have a conversation with you offline about this. If you're actually interested in learning, I'm happy to have a conversation with you about this. But I'm telling you, I've gone through IUL and whole life more than probably anybody else you'll ever meet. As far as I've sold IUL, I've gotten away from that because of what I know to be true and what I've seen, actual results. I don't care about illustrations. I care about actual real life performance. And you want to see what it really looks like. The information that you find on Google is not going to be accurate. You got to spend money and buy into research from Dalbar and buy into research from people like Life Product Review and Bobby Samuelson. Do stuff like that. That's the information that matters. Nothing else matters. It's all derived from third-party sources that have their own agenda, right? Like anybody bashing on whole life that's saying it's going to perform less, it's probably they got that from Dave Ramsey or something like that. And IUL feedback's going to be from companies that are trying to sell it and inflate their numbers to higher than it really is, So I take a Google search on this topic about as seriously as, I don't know, a unicorn, right? Like it's not real. So it doesn't really matter. But let's talk about this. I always kind of talk about the different phases of life and the importance of it. And your needs as a person are going to change as you go through life, right? I think it's absolutely essential that you think about getting your dollars to perform multiple functions. That's another form of leverage, right? And by having your money go into a whole life policy, you could see that, yes, you have your emergency fund and opportunity fund, like I talked about. That's there. You have life insurance, which I talked about, but you also have the living benefits. And so all those things are tapped in. Now, this is a 44-year-old right here. Me at 43, a year from now, I'll be 44. But imagine as somebody younger, you want to save money. You want to save with the purpose of investing. We want to build this cash up to be able to invest in real estate. We want to leverage that to get real estate that can compound and give good returns. But then as we go through life, it's going to help us with different stages. We're going to have the liquidity, the use, the control of the money. We're going to have the death benefit. I call this a self-completing plan because rather than saving in a bank account when we die, this completes and accomplishes all the goals that we're after, right? It makes sure that what we want to happen will happen when we want it to happen, even if we're not here to see it. Yeah, exactly. Trent, do the IUL challenge. Thank you. Somebody said it. I didn't want to have to beat on my drum that much. So that's I would say that the power of whole life insurance is the fact that it literally is solving multiple functions in your life, multiple problems in your life. And the beautiful thing is, as you go through life and your needs and desires and wants and all that change, this product evolves with you and it solves different problems. It's going to be your emergency fund, your opportunity fund. It's going to be there to protect your family. It's going to be there to help fund kids' college. It's going to be there, when you hit retirement and you need a volatility buffer for income. It's going to be there when you want to be able to control your medical directive, when you get a bad diagnosis and you don't want to be beholden to the health insurance company telling you that you can only do this treatment, this treatment, and this treatment because that's all they're going to cover. And there's another treatment that's going to help you, but it's going to cost $50,000 and you can't do it. Well, this is going to enable you to do that. My father-in-law had to spend almost $200,000 out of pocket on his treatment for his pancreatic cancer because insurance wouldn't cover it. Yet 2 years later, after given a 90-day death sentence, and anybody that knows anything about pancreatic cancer knows that, it is what it is. To be able to have that kind of control to control your medical directive, to me, it's worth its weight in gold. Can illustrations be inflated and show what you want to see? No, not really. No. So that's one thing. Illustration regulation is really changed. Back in the day, you could manipulate IUL illustrations. Now they kind of set the terms. Illustrations cannot be manipulated more than you want to see so much. I think the assumptions are inflated on IULs, but with illustrations, with whole life insurance, it's always just using the current assumptions. So I'll just pull this up here. So when you look at, where's my cursor? Yeah. Hold on, can't see what's happening here. There we go. So when we look at this, the non-guaranteed assumptions. So there's a guaranteed column in a whole life policy, and there's a non-guaranteed column. The non-guaranteed column, everything is guaranteed except for the dividend scale. And so what it's saying is it's assuming 100% of current dividend scale. So what could happen is if the dividend went from 5.2 and dropped to 5.1 or 5, this is going to produce a little worse. You just got to know that. Conversely, if the dividend went to 5.4 or 5.5 or 6 or something like that, this performance is actually going to get better, right? So it's just, you got to understand what you're dealing with and what the variables are. But that's one of the reasons that I love whole life insurance, is just, especially right now, I really believe that they're going to perform better than how they're being sold, just based on the market environment that we're in. And I think that's really important, but you can't inflate it. You can't change those numbers. You're always showing it based on the current dividend assumption of a company. And those variables kind of come into play. So anyway, my computer just bugged out on me again. So anyway, does that help? We're approaching 2 hours. I went way longer, obviously, than I expected to. Hold on, let me see. Did I cover everything I wanted to cover? I want to make sure I touch on this because the idea of this was I wanted to cover and make sure that the whole life versus IUL. Hopefully, I think I've communicated at least on the points that I've taught, that I've covered why I believe whole life is a better, solution. The living benefits, I think, are important because I'll breeze over these because I think I touched on them without getting super specific, but I think the way that I touched on them will be good, or be sufficient enough. When I look at the retirement income, I think it's important to know that life insurance companies, if you want retirement income from a life insurance company, buy an annuity. That's basically income insurance. It's personal pension. It's great. There's no better way to optimize retirement income than doing an annuity, and that's important to understand. Tom Hegna wrote a great book, Paychecks and Playchecks. You're using mortality credits and you're leveraging that to increase your annualized return inside of your annuity. That's the only way to maximize your internal guaranteed annual income and from leveraging the assets that you have, if that's important to you. But when it comes to whole life insurance and IUL, I think IULs are dangerous on the income side because of the danger that policy loans inject for risk into the policy, right? Like the loans for income in retirement for IULs inject a lot of risk into the policy. And I've got videos that I've gone into like great depth. Actually, on the illustration that I was sharing on this, I went into super, super depth. And I think go back and check that out. If you want to see what I'm talking about there, look up Allianz Pro Plus Advantage review and you'll find my video and you'll be able to go, do a real deep dive on that. And that I think will help you really understand that. With whole life insurance, I would say you shouldn't ever rely on whole life insurance for income every year. Whole life insurance is an asset that is a great volatility buffer because it's going to get better and better and better every year, right? And when you know that you have an asset that's part of a bigger portfolio that maybe is real estate driven or you have equities or other assets that you're leaning on for income, having your whole life insurance policy on those 25 to 30% of the years where the market's down, utilizing your whole life policy as a volatility buffer to use for income and take more income out of that when your other assets are performing negatively, that actually allows those other assets to recover and it improves the overall performance of your investment portfolio and you can get more runway out of it and it increases your chances of having your retirement portfolio last for your whole life. That's good. Living benefits are only as good as the policy being there. And I think the risk of everything that we've talked about with IUL living benefits and whole life living benefits are pretty comparable to each other. I think it's important to understand. A lot of people don't think whole life, a lot of IUL agents, I've heard this say, and to me it's like malpractice, but I hear them say like, IUL has living benefits and whole life doesn't. Well, nothing could be further from the truth. Whole life invented living benefits. And the living benefits are very, very comparable. So when we look at it that way, the living benefits are only as good as the policy actually being there and being enforced. And the odds of a whole life policy being enforced are drastically higher. Therefore, the living benefits win with whole life. And then from a legacy, I would say the same thing. Look at the guarantees. On a guaranteed basis, what kind of legacy and death benefit is this going to leave to hit the next generation? And that's what it comes down to. So, I've got 7 points here, from emergency fund, opportunity fund, real estate, business reserve, retirement income, living benefits, and legacy. And in every situation, whole life insurance beats IUL. Trin, I got nothing for you. IUL is not a rich person's Roth IRA. Nothing. It's great marketing, but nothing could be further from the truth. So IULs are dangerous all the way around because of the unpredictable nature of them. And people like Trin that sell them, obviously. Once again, I would say, Trin, I'll believe you when you can show me, because I've done this and I've looked at literally thousands of policies, and I've done personally hundreds of them, and even when I was designing them and doing them max efficiently, yet to see one long-term perform as well it was sold, and that was during the greatest bull run of all time. It's going to get worse as the market moves forward, performing worse. And so that's it. Any questions, any comments, anything here for the rest of this time? We've been cranking, going a long time. This is the longest live that I've ever done, by the way. So y'all are here for history. In over 1,000 videos that I've ever done, I think this is the longest YouTube video I've ever done. I didn't realize I was going to do that. Anything else? I'm going to give it a couple seconds, and that's it. Otherwise, I think I'm gonna bounce. I'm gonna go hang out with my son and go watch him play soccer. I don't know if anybody watched the Women's World Cup game, but that was so sad the way they lost the other day. That was horrible. All right, I think that's it. Nobody's chiming in. Nelson, good to see you here, buddy. But yeah, guys, thanks for being here. Hopefully you found value in this. Hopefully this was educational. And if you are, once again, if you are interested in having a conversation with me or somebody on the team, getting a clarity call, getting better assessment of your needs, what you're looking for in this, just getting more clarity about how this, concept, the product could work in your life, where it's a good fit, in any capacity, whether you're a business owner, a real estate investor, you're looking to get out of debt, any of that stuff, I would say just reach out down in the link in the description below. There's a clarity call link. If you're an agent that is looking to join an organization that can actually train you on this stuff and not just try to encourage you to recruit people, I would say go down, have an agent interview. And if you're in a debt-based situation, we have a separate link for that one as well. We try to be very focused on what the conversations are about based on your different needs and desires. So that's it. Hopefully you guys had fun. I did. Thanks for being here. Miguel, awesome talking to you, brother. I'm glad we got the chance to talk earlier. Yeah, it was amazing. So it's excited to work with you, man. It's gonna be fun. But yeah, guys, that's it. Have a blessed, inspirational day. We'll talk soon. See ya.